Hey everyone, it's Mike Valtos from Orderflows, and welcome to today's presentation on how to spot market exhaustion that leads to big market moves. Now, in this presentation, I'm going to discuss two different forms of order flow analysis, which when used separately are powerful on their own, but when combined can give you some beautiful, powerful trading opportunities, and they are market imbalances and market exhaustion. But before I begin, I just want to introduce myself for those that are new to me. My name is Michael Valtos. I've been in the futures industry since the early 90s. I started on the CME floor as a runner with Dean Witter. Eventually, I left the trading floor to go trade upstairs on the off-the-floor trading desk when Globex was starting up. After that, I left there for EDF Man for a few years. EDF Man is a big English commodity trading firm. Then I joined Commerzbank for 3 years. I was a licensed Eurex trader based in Chicago, trading Bunds, Bobbles, Schatz, DAX, Euro stocks, and the other smaller indices like the banks and tech indices. Then I joined Cargill. I spent 4 years with Cargill as a trading desk manager. We traded every commodity basically you can imagine in the world. Then I joined JP Morgan. I spent 8 years there as vice president of futures trading. This was a job where I sat on the trading desk trading. I didn't sit in some corner office looking at spreadsheets. No, I would come in at just before 6 in the morning, and I would leave around 5 in the afternoon. Did this for 8 years. After being tired of that, I realized that's not what I want to do with my life anymore. I was in my 40s, and I left. I said I can't do this because I've got a family now, and I need to spend time with them. So I left and I started trading for myself, my own account, and I started writing my book on trading order flow. And in 2015, I started Orderflows.com. Now, what I'm about to show you can be applied by any trader who wants to see market exhaustion and market imbalances. Most importantly, I'm going to show you how to see these order flow opportunities on a normal bar or candlestick chart. So you don't need to look at a DOM or volume footprint chart. You don't need level 2 data. You just need a normal chart to look at it. Now, before I begin, I just got to go through a brief disclaimer. Please realize that trading involves risk. Past performance is not necessarily indicative of future results, and please only trade with risk capital that you can afford to lose. So, the first part I'm going to talk about is market imbalances. And market imbalances are one piece of order flow data that can transform your trading. So let me ask you, are you using it? Most traders, they're not. Most traders are unable to determine when imbalances are happening right under their nose. And why are imbalances important is because, just like this truck versus the Corvette, the truck wins. It's going to win 9 times out of 10 because it's bigger, right? And that's what happens when you have a market imbalance, right? You have bigger size versus smaller size. I tell my wife, I said when I buy a car, I always want a big car because, if I'm going to be involved in an accident, I want to be protected. There's protection in numbers. Now, most traders are unable to determine when imbalances are happening. Why? Is because number one, they treat all traded prices the same, and number two, they treat all traders the same. So what does that mean, right? Treat all traded prices the same, treat all traders the same. Well, let's break it down. The first one, all prices traded are not the same. It's not a car is a car or a purse is a purse, right? You have a Ferrari or you could have a Volkswagen, right? One is going to be better than the other for other reasons, and same thing with price. There could be a certain price that's traded could be more important than a different price. Just as a purse, right? Louis Vuitton versus your canvas handbag, which is going to be more expensive and more valuable. Well, it's going to be the Louis Vuitton bag because it's it's hand stitched, it's made with leather that's going to last longer, and I hate to say it, but being more expensive, sometimes people are going to take better care of it. All right, so for the men can relate to this. I'm married, yet every time I go shopping with my wife, she wants to go to Zara. There's a Zara in pretty much every major shopping mall across the country, yet she's got to go in. I'm like, why do I always got to go to Zara? Right? They're all the same. Well, no, they're not. This one may have something here on sale. This one may have, these other clothes or whatever. Okay, I just go with it. But, just as not all prices are the same, not every Zara outlet store, whatever you want to call it, is going to be the same. Now, number two, traders are different, right? Each trader has a different reason for entering a trade. There are speculators, there are hedgers, there's real money accounts, there's producers, there's CTAs, there's hedge funds, there's algos, and etc. There's probably some that I haven't covered. Now, once you understand that there's different types of traders and there's different prices, importance, being traded, you got to understand that within the different types of traders, you also have different sort of classifications of traders, right? You have passive traders, you have aggressive traders. Passive traders are willing to wait for the market to come to them. They work bids or they work offers. Aggressive traders need to get into the market right now without waiting. They're going to buy at the market. They're going to buy the offer or they're going to sell the bid. But, people sometimes they don't understand what that really means. Well, there's a difference, right? You have passive fishermen and aggressive fishermen. Hopefully everybody understands what a fisherman does, right? So if you're passive, you just want to sit on the rocks, throw your bait in the water, let the fish come to you. You're passive. If you don't catch a fish that day, that's fine. You'll eat something else. Aggressive trader, an aggressive fisherman rather, he's going to go out into the water where the fish are. He's going to throw his net to the area where the fish are. He may even throw bait in there just to get the fish to come to him, right? So he's being aggressive in the sense that he's going out and actively catching the fish, whereas the passive fisherman, if I catch a fish, great. If not, I had a good time. I sat out here in the nice air, I had a beer or two, and I enjoyed myself. So whether he catches a fish or not, he doesn't care. The aggressive fisherman, he needs to catch a fish. He needs to eat. He needs to catch a fish to sell, to put food on the table for his family. So on a dome, right? Most people are familiar with a dome. And you have passive buyers on the bid side. They're working the bid and they're working bids below the bid. Passive sellers work the offer. They work offers above the current offer, right? If they don't get elected, no one trades with them, they're fine. They could live. Whereas an aggressive trader is someone that's going to lift the offer from the passive seller or sell into the bid and sell into the passive buyer. So who's going to move the market now? Think about it. What makes the market go up or down? Passive traders or aggressive traders, right? Go back to your dome. Well, if the market's 55.75 bid offered at 56, okay, that's great. It's not going to trade, right? For it to trade and the market to start moving, someone has to buy at the market or sell at the market. Someone has to lift the offer. Someone has to hit the bid. So now that you understand the difference between aggressive traders and passive traders, you can understand when there are imbalances in the market. Because when an imbalance occurs, right, what you're going to have is you're going to have a certain amount trading on the offer versus the bid, right? And when it reaches a certain level, a certain percentage, that's what's called an imbalance. So let's go back to our dome, right? All the bids and all the offers sitting in the order book are passive traders. Remember, right? They're passive because they're waiting for the market to come to them. So for a trade to occur, someone has to be aggressive. For a trade to occur, there must be a trader who either sells into the bid or buys from the offer, right? For the market to move up, all the offers at a price must either be bought by aggressive buyers or all the offers at the current offer be pulled out of the market and a new higher offer is present, and hopefully that trades. For a market to move down, all the bids at a price must either be sold by aggressive sellers or the bids pulled and a new lower bid present. So for example, if the market's not going to move if no one's buying the 56s or selling the 55 3/4, right? It's just going to sit there. People are going to try to buy it at 55 3/4. People are going to try to sell it at 56. So for the market to move, someone has to sell into the bid or buy the offer. So markets move up on aggressive buying. Traders are buying the best offer. They're clearing it out, right? And then buying the next best offer. While at the same time, the aggressive selling is not enough to clear out the best bid, right? So what's happening, right? Remember, markets are a two-way auction. So there's people constantly buying and selling, right? People are buying the 56s, selling the 55 3/4. But for the market to move, the buying has got to be more than the selling, right? And if it's more than a certain amount, you're going to call that an imbalance. So for a market to move down, all the bids at a price must either be sold by aggressive sellers or the bids pulled and a new lower bid present, right? The markets that will move down on aggressive selling. Traders are selling the best bid, clearing it out, selling the next best bid, etc. Right? For the market to move down, someone's going to have to sell the 55 3/4 and start selling the 55 1/2. Once those are cleared out, some can be pulled. The next bid is 55 1/4. Someone hits all those, next bid 55. That's how a market moves down. Now, that's not to say there's no counter trade. There might be people offering it down here as well, and a couple buyers come in and buy some. Okay, but in general, what you have is an imbalance. You have more people selling. That's what caused the market to go down. So on a normal candlestick chart, you only see price movements, right? You don't see, well, who's buying at a price level, how much they're buying. On a dome, you can see it in real time, but then it's gone. Some of these domes nowadays are a bit more fancy. It'll track the numbers that traded, but you sort of got to be Rain Man and sit there and try to figure out, okay, what was this one that happened 30 seconds ago? What's the importance of that volume that traded? Now a footprint chart, right, allows you to see it in real time and frames it in an easy to read format. So I can see when there are buying imbalances in a bar. I can see when there are selling imbalances in a bar, and those will be highlighted in the volume in a bar. So those of you that are not familiar with an order flow chart, this is what an Orderflows trader footprint chart, this is what it looks like, right? And you can see that over time it tells a story, right? You can see how the bars are forming, volumes being traded. I can see when there's buying imbalances, that would be the blue numbers inside of the bar, or a red number inside the bar would be a selling imbalance, right? And you can see how it's it's more relaxed. It's not as stressful as, say, looking at a dome where you're sitting here trying to figure out, oh my gosh, what does this mean? It gives you a more classical sense of what's happening in the market, more of a tape reading. People say, well, if you're a tape reader, you should be looking at time and sales. Honestly, the way time and sales move so fast, you can't keep up with it, right? You need something that puts that information into an easy to read format, and that is a footprint chart. All right, so now that we know what makes the market move up and down, it's aggressive trading, right? How do you determine if an imbalance is occurring? Well, you look at the ratio of aggressive buying at the offer versus the aggressive selling into the bid, right? I had hinted at that. So this is why using a footprint chart is useful, right? Because you're going to be able to see that volume in the bar. So for example, 500 contracts traded on the offer, meaning 500 contracts were bought by aggressive traders versus 400 contracts were being sold into the bid by aggressive sellers. You'd be looking at 500 versus 400, not perfectly matched, but still relatively even, right? But what if you had 500 lots trading on the offer versus just 50 lots traded on the bid? Well, that's 500 versus 50. That would be considered an imbalance. Why? It's 10 to 1, right? When you have 500 versus 400, that's not an imbalance. You're pretty much even in a general sense. People say, well, 500 is not 400. Don't get your panties in and, too tightly wound up. You're looking for excesses in the market, right? 500 versus 400, again, still relatively evenly matched. 500 against 50 is not evenly matched. For a perfect example, figure out which is balanced, right? 1 against 1, 1 against 4, 1 against 6, right? 1 against 1, the one guy on the left may weigh 150 pounds, the guy on the right, maybe 170 pounds. Okay, there's a weight discrepancy there of, 20 pounds, but still relatively evenly matched. But you could have one, the guy on the left could weigh 150 pounds, the guy on the right could weigh 150 pounds, evenly matched, but then the next guy 150 pounds, the next guy 150 pounds, the next guy 150 pounds, right? So you got 4 guys against 1 guy, and obviously 6 against 1 is not an evenly matched. Definition of imbalance is lack of balance, right? The state of being out of equilibrium, out of proportion. The whole concept of market profile deals with balance in the market and when the market's not in balance. So if you don't think that knowing when the market's imbalance is not important. I think you're leaving an important piece of information out of the trading equation. So in the order flow, you must decide what you consider an imbalance between aggressive buyers and aggressive sellers. The starting point that most people use is 4-to-1, 400%. Some traders use 3-to-1, 300%. Other traders use 10-to-1, which is 1,000%. It's up to you to decide what's best for you. I'm telling you right now, most people use 400%, 4-to-1. What does that mean? Well, if you're looking at an footprint chart, you can see what was traded on the bid, what was traded on the offer. So for example, this green bar right here on the right, okay, you see 70 against 0. Well, 0 against 70 lots traded at 32.38 versus 0 at 32.37 3/4. 0 against 70, obviously more than 4-to-1. That's a buying imbalance. Okay, now go down 1, 2, 3, 4 bars earlier, right down here, sort of towards the middle, you see 51 against 9, right? So 51 lots traded on the bid at 24.5 versus 9 lots traded on the offer at 24 3/4. So you have, that's about 5-to-1. That exceeds the ratio of 4-to-1. So you have a selling imbalance, right? You have 51 lots traded on the bid versus only 9 traded on the offer when the market was bid offer there. Okay, now you're going to have a lot of black numbers. That's because there's no imbalance. That's just your regular order flow. You can see these bars here, this red bar on the bottom, towards the low, 50 against 109. Okay, it's not an imbalance. It's a 2-to-1 ratio, more or less, but it's not considered an imbalance because I'm using 4-to-1. 137 against 371, again, not an imbalance. It's about 3-to-1. 377 against 481, not an imbalance. 450 against 603, not an imbalance. 625 against 175, not an imbalance. It's close. It's about 3-to-1, but it's not 4-to-1. Again, it's not a line drawn in the stand that you have to use 4-to-1. Again, some people prefer to use 3-to-1. Some people use 5-to-1. Some people use 6-to-1. It's up to you to find what is the level that you're comfortable with. If you have a very low threshold, you're going to get more imbalances. If you have a very high threshold, you're going to get less imbalances. So, trying to see it on a dome, you're not, right? It just happens so fast that you're not going to know. You can't sit here and do the math in your head on how much traded, on the bid, on the offer, right? On a bar chart, you don't even look at the volume that's traded in the bar, so forget about it. A footprint chart puts it in a nice, easy to read form that you can make a trading decision. So now that you can identify an imbalance in the market, how are you going to use this information? Well, what you want to do, obviously, is you want to highlight the clusters of imbalances, but not just stacked imbalances, but bars with multiple imbalances in them. So let me just break that down. So what is a stacked imbalance? Well, you can see that's this green area in the middle of this chart, right? You have 109 against 710, 30 against 190, 11 against 151. That is called a stacked imbalance. The imbalances are stacked one on top of the other on top of the other. Now, this is what most traders look for because it helps them to define near-term support, right? If it's a stacked buying imbalance, or resistance when a stacked selling imbalance appears, right? So, for example, market's going down, you get a stacked selling imbalance. Aggressive sellers come in, hit the bids, but you clear out all the bids there. It leaves this footprint, so to speak, of a stacked selling imbalance. And you notice what happens? The market now, we come back into that area, it's acting as resistance, right? It's a selling imbalance, right? You can just see how the market can't really get past it. It gets one tick above, and it holds as the market sells off. Another example, we're here at the high of the day. That's this green line. Stack selling imbalance comes in, it appears, right? We hit our high of the day. Sellers are coming out of the woodwork, start hitting all the bids. Market starts selling off. Market just trades back up into that imbalance before falling over. Now I've got a market-generated resistance level. Now, there's another form of imbalance, and very few people really talk about it. Excuse me, drink of water there. And what it is, it's a multiple imbalance, and what that is when you have 3 or more imbalances in a bar, but they're not neatly stacked on top of each other. When they stack neatly on top of each other, at the high of the day, that's great. That's just textbook charting. People are going to post it up online, see, order flow is the greatest thing, etc. Here you got obviously aggressive sellers coming into the market, but just because they're not stacked on each other, on top of each other, doesn't mean they're not important, right? Most traders are, that's what they're taught to look for in order flow, is this, right? They're taught to look for the stacked imbalance. They're taught to look for this red zone, this green zone. All the major footprint chart software has it, but what my order flows trader software does is it also looks for bars with multiple imbalances. And as you can see here, you don't see any stacked selling imbalances. Instead, you're seeing multiple selling imbalances in a bar. So my software will put a purple box around it, around the bar. It'll put the box around whether it's a stacked buying imbalance or stacked selling imbalance, right? You obviously have eyes. You can make that determination. I never thought it was useful to have, all sort of different colors for stacked buying and multiple buying imbalances, multiple selling imbalances, because the best computer is the one between your ears. But I can see 1, 2, 3 selling imbalances. Next bar, 1, 2, 3 selling imbalances. A few bars later, 1, 2, 3 selling imbalances. What's happening? We're coming up to a swing high here. Aggressive selling is coming in, but it's coming in sporadically, right? Not all big traders have a big order and they're just going to run through the market. Oh, just sell me my 500 S&Ps right now. They're going to sell a little, let the market breathe, sell some more, let the market breathe, sell some more, let the market breathe. They let the market breathe so it comes back up and they can sell at a better price rather than just coming in with impunity and hitting all the bids. Sometimes that works for them, sometimes it doesn't. Sometimes the market doesn't come back, sometimes traders pick up on it, right? Here we are, we're at our low of the day. What's happening? Market starts ticking up, and then boom, the aggressive buyers appear. You get this bar, you got 1, 2, 3, 4, 5 buying imbalances. This is a 30-second crude chart. Okay, over here, 5 bars later, you have a stacked buying imbalance, right? And then the market goes higher. Well, you're being alerted earlier with the multiple imbalances rather than later with the stacked imbalances. And as you can see on this previous chart, you don't even have stacked selling imbalances. So if you're sitting here looking for stacked selling imbalances, you're going to be waiting. It's the way I would describe it in a sense is, these people that use these fancy technical indicators, bat patterns. Don't be sending me hateful emails. Bat patterns are the Gartley's are the greatest thing ever. If they work for you, fantastic. But oftentimes you're just sitting around waiting and waiting for something that just never appears. And if you're going to be sitting around waiting and waiting for multiple imbalances, they appear a lot less than, if you're just sitting around waiting for stacked imbalances, they appear a lot less than multiple imbalances. And more importantly, multiple imbalances often occur ahead of stacked imbalances, right? As you can see in this chart, right? Here's your multiple imbalances. 5 bars earlier than your stacked imbalance. So while multiple imbalances are not visually appealing as a stacked imbalance, they're just as important, if not more important, to traders. Multiple imbalances and stacked imbalances tell you the same thing. Aggressive traders are present, right? The difference is on a stacked imbalance, aggressive traders are piling into the market right now. Bar with multiple imbalances tell you aggressive traders are active, but they're trading in waves. They're trying to hide what they're doing, right? And it's let me ask you, what do you think is stronger? A trader shows you his aggressiveness at once, or a trader hiding his aggressiveness? Perfect example. There was an interview with Lance Armstrong. Okay, yeah, I know he used PEDs during the Tour de France, but he, in one of his interviews, he was telling the guy at ESPN, when he was riding up the mountain, he would pretend that he was out of breath, that he's got no more strength. So the other riders would get a little bit excited about that and try to expend more energy now. But what he was doing was he was hiding his aggressiveness. Now in baseball, the pitchers, Pitchers really control the game. It's in baseball. It's not like the Cubs against the Yankees. It's the pitcher of the Cubs on that day versus the Yankees batters, and vice versa. The Yankees pitcher against the Cubs batters. But there was a pitcher for the Cubs years ago, Greg Maddux, and he was a great pitcher for the Cubs. He eventually left and joined Atlanta, where he prospered. Remember, for the Cubs, he won like 21 games or something. And for the Cubs, winning 21 games is winning like 30 actually. But what he did, one of the reasons why he was so successful is because he hid his pitches, in the sense that, he knows that he's going to see a batter probably later in the year, right? If you're playing on a good team, you're going to be in the playoffs, and, you don't want to give any advantage to a player. So what he would do is, late in the game, when the game probably didn't matter earlier in the season, is he would just throw one up for the batter to hit, right? Because his thought process was, well, I know I'm a good pitcher. I'm going to throw this ball now, so the guy, when I face him in a critical game, right? Maybe not this year, maybe, it could be 6 months later this year, or it could be next year. That player, that batter, is going to be thinking back to when he faced me and when he got a sweet ball to hit. But what I'm going to do is I'm going to trick him. So the pitcher, he's hiding his aggressiveness in that sense. He knows he's got the stuff that he could get this guy out with, but rather than show it all at once, he's hiding it. So what do you think is stronger? Showing all your aggressiveness at once, or hiding it? Personally, I think hiding your aggressiveness as a trader is more important. Now, of course, there's times when a big trader doesn't really care, just wants to, if he shows it, he shows it. If not, okay. But, over time, you got to be hiding your size. That's why all these algos, execution algos, exist now, so big traders can hide what they're doing in the market. So here's a piece of advice, right? Bars with multiple imbalances often occur before bars with stacked imbalances appear. Bars with multiple imbalances often occur in early stages of moves. So here's a chart with multiple imbalances at the start of a trend right here. You're at your low of the day right in here, right after this is E-minis. This is a 1 minute chart, right? 845 coming into the lows, 846, 847, and then boom, the aggressive buying appears. 1, 2, 3 imbalances in the bar. Next bar follows up with another 3 imbalances. Here you have 2 imbalances. Right here you got 2 imbalances. Now my software, you could decide, whether you want to see 2 or 3 or 4. I think this one I have set to 2, but again, that's up to you to decide. Now, this presentation is not about selling you my software. I'm talking about, imbalances and market exhaustion. But I know many of you guys have my software, so I just want to explain that out real quick. Now, do you see any stacked buying imbalances? No. If you're just sitting back waiting for stacked buying imbalances to buy or sell, well, you don't have any. But you're at your low of the day, and all of a sudden you're seeing aggressive buying come in. Right? That's important information. Okay. Here you go, right? You get the little push up, bars with stacked buying imbalances. Okay, then you hit this swing high. All of a sudden, the aggressive selling comes in. 1, 2, 3 bars. You got 3 bars up, stacked buying imbalances. Then all of a sudden, you got 3 bars down with stacked selling imbalances. Well, do you think this market's going higher? No. The buying imbalances are no longer there. Just as, you got these little bars in here with, 2 selling imbalances, 2 selling imbalances. Okay, maybe you can start selling off, but then you see the aggressive buying just comes right back up, continues in the next bar, into the next bar, but then it stops. Right? If aggressive buying stops, what do you think is going to happen? Market's going to go up, it's going to go down. Well, it's going to go down if there's no more aggressive buying. So what you like to see is multiple bars with multiple selling imbalances at or around the high of the day, which often precedes a sell-off, just as you'd like to see at the low of the day, multiple bars with multiple buying imbalances at or around the low of the day, which often precedes a rally. And again, this is a great example, right? Mini Dow, we're at our high of the day. You got stacked selling multiple selling imbalances. You got this bar, 1, 2, 3, 4 selling imbalances. Market makes a new high by a tick, not the end of the world. Then you got another bar with 3 selling imbalances, another bar with 3 selling imbalances, then look, the market just drops, 60 ticks. And this is a minute chart. You got your big stack selling imbalance in here, great. But you want to be alerted before you get that big bar down with the big stack selling imbalance in it, right? Where would you rather be short from? Up here at 28,820, or short from 28,790? Well, you want to be short from up there, of course, right? So you want the signs coming in as early as possible. And again, if you're looking at a normal bar or candlestick chart, you don't see any of that information. This is that same footprint chart here on a bar chart. You don't see the stack selling imbalance. You don't see at this high of the day. You don't see multiple selling imbalances. You don't see as the market rallies back up, makes a new high by a tick, comes back up, circles back up towards that high, starts coming off. You don't see the aggressive selling in these red bars. You just see red bars. People say, well, you got red bars, that's bearish. Well, okay. Well, we were bearish here. We were bearish here then. Double doji. Double doji. You gotta trade that. Okay, fine. But just because you got red bars doesn't necessarily mean you have aggressive sellers in control of the bar. It just means the bar closed lower than where it opened. What you're looking for is the aggressive selling in the bar at prices in the bar. And again, if you're looking at a normal bar chart, this is your same bar chart, right? Here's your imbalances here, here, here. That's your normal bar chart. Can't see it. This is the bar here with this blue triangle is some buying imbalances. The red triangle down is your multiple selling imbalances, right? It wouldn't be nice to have a tool that highlighted to you where there are bars with multiple buying or selling imbalances? So let me ask you, if you're looking at this chart, can you spot the aggressive selling? No, you can't. You'd just be guessing. But this is where it occurs, right? It's right here. There's these blue areas here. You can see these are the bars with multiple buying imbalances. The red areas are the multiple selling imbalances, right? People say, well, you had these two, the buying imbalances that didn't work. Well, okay, fine. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times that did occur. So 2 didn't work, but look at that. You've got 8, 9 that work nicely. So, that sort of wraps up the part on imbalances that I want to talk about, because the next part that I want to talk about is market exhaustion, all right? And eventually I'm going to tie them both together to show you how you can take advantage of it in the market. So, moving on to market exhaustion, this is the second part. It occurs basically when the last buyer has bought at the high of a move or the last seller has sold at the low of a move. Okay, and what does that look like? It looks like a reversal, basically. Now, the high or low can occur in a move or can occur in a bar. So again, if you're looking at a 15-minute bar, what's that made of? It's made of 15 one-minute bars, right? So within a 15-minute bar, there's going to be swing highs and swing lows. If you're just looking at a 15-minute chart bar, you don't know what happened, right? Here, we opened up, sold off, rallied back up, sold off, then closed, right? That's what a bar, a time-based bar looks like, right? It doesn't show you what's happening. It just shows you where we opened, where we closed, what the high and the low was in the bar. Now, market exhaustion is identified by looking at the volume at the ends of a bar. If we know market exhaustion occurs when the last buyer has bought or sold, last buyer has bought or the last seller has sold, where do you look for it? Well, you look for it at market turning points, right? What happens at market turning points? Well, the market reverses, right? Just as I showed you here, right? Imagine you get up to the high up here and you see very little volume being transacted at the high. Well, it's telling you buyers aren't interested in transacting at this high. Just as, on the red chart here, right? We get down to that low, and there's very little interest, selling interest at that low. Well, it's telling you sellers aren't interested at that low. At a reversal high, what do you need? Well, you need a red candle, right? The price action has to show you the market is undergoing a reversal, that the market has to have reached a high and is now selling off. At a reversal low, what do you need? You need a green candle, right? The price action has to show you the market is reversing, that a low has been made, and it is now rallying, right? And this is where order flow comes in. By looking at a volume footprint chart, you can see the volume that goes through at the highs or the lows, right? If you're looking at a normal bar chart, you're not going to see what the volumes are transacting at this high or at this low, right? You're just going to see, well, we had a high up here, we had a low here. Okay. Very weak volume at the high tells you there's very little buying interest in the market at these levels, just as very weak volume at the low tells you very little selling interest remains in the market. Again, if no one is buying at high prices, what's the market going to do? Well, think about it, right? If you're at high prices, but no one's buying anymore, market's not going to go up. It's going to sell off. It's going to drop, right? If no one's selling at low prices, where's the selling pressure? It's no longer there. Market's going to rise. Buying is going to outnumber the selling. And again, the key is to be able to identify this small volume, right? Now, let me preface that by saying some markets trade a lot more volume than others. As a result, you can and should think about how that affects the definition of small volume. For example, small volume on NASDAQ could be 5 lots or less, on a 1-minute chart. But for the E-minis, maybe you want to consider 25 lots to be small volume on a 1-minute chart, because the amount of volume that gets traded, on a 1-minute chart in the E-mini S&Ps is a lot more than the volume that goes through on a 1-minute NASDAQ chart. But again, you could keep it the same. You keep it 5 if you want for both. For highly liquid markets like the 10-year notes, maybe you're going to consider 100 lots small volume, because each price level is trading, 5,000, 10,000 contracts. So, 100 contracts isn't very much, relatively speaking. Now, if you're looking at a normal bar chart, you can't see the volume that's being traded. People say, oh, yeah, you had the swing high here, we sold off to the swing low, you rallied up, they come up with a lot of excuses, a lot of reasons why they would have sold here and bought here. We all like to look at a chart and I would have bought here, I would have sold up here. But the reality is that's not how it works in real life. You need a chart that shows you the volume that's traded, right? And again, my Orderflows trader chart will highlight those numbers to you. So you can see here, right, this green line is the high of the day. As you hit the high of the day, you have this little red box up here, 2 lots traded in there. You come off, rally back up towards that high, you got another red box, 4 contracts, market sells off. What it's telling me is at this high of the day, buying volume dried up. It hit it. And you can see each time you hit the high, volume is less. And the last time you hit it, you only got 2 buyers up there. Market sells off, makes another run up towards the high. But again, so it hits this level and can't push through it. The last time it trades that, only 4 contracts go through. No buying interest. Market's exhausted. They don't want to buy anymore. Right? You need a chart that's going to highlight that information to you. Right here, you hit your high. Hey, this is great. I got this bar. I got a stack buying imbalance. We're at the high of the day. FOMO, baby, FOMO. Let's buy it. What happens? Market doesn't go any higher in the next 1, 2, 3, 4, 5, 6 bars. We test the high again, test it again, 3 contracts trade. Where's your aggressive buyers? Earlier you're coming in here, coming up to the high, you got aggressive buying going on, but traders aren't able to take it any higher. Test the high again. Nobody's interested. Nobody's interested to buy. What do you think is going to happen? Market's not going to go higher. It's going to start going lower. And you see how it does that. Now, how are you going to do this, right? You could look at time and sales. You could look at a dome. Or you could look at a volume footprint chart. Right? It's like Goldilocks and the 3 bears. Trying to figure out what you should use. Time and sales, dome, and a footprint chart. Well, this board's just too hot. This one's too cold. This one's just nice. This bed is too hard. This one's too soft. This one's just nice. Well, I prefer a volume footprint chart. Now, there's going to be some people that are going to say, no, you got to look at a dome. No, you got to look at time and sales. I like to make things easier. I don't like to sit here and stare at a dome that's going berserko on me, especially at busy times in the market. I like to look at a footprint chart because it gives me a more relaxed, pressureless environment to trade in, honestly. And as you can see here, right, this green box around the number is telling me there's a small print here. It's telling me there's market exhaustion, right? There's only 6 contracts traded here at the low. Come back up, start testing the low, only 4 contracts traded here. We start rallying again. Market puts in, at the low of this bar where you have the multiple buying imbalances, you got market exhaustion at the bottom. No one's interested in selling here. People are interested in buying. These are all clues that you can use in your trading, right? And again, remember, there's safety in numbers, right? Primal animal instinct, right? Safety in numbers, stay together, right? Well, the lion, what he's looking for is the weak one, right? He's looking for the one that's straggling off on the side here, right? That's his easy prey, either the old guy or, the one that's injured or the one that's just, daydreaming on the side, not paying attention. That's where he's going to get his dinner. And trading is the same way. You're picking off these areas on the chart, right? These are the stragglers, so to speak. That there's no interest there, right? And if you're alert to those levels, that don't expect the market to come back to those right away. So this is an E-mini 5-minute chart, okay? And as you can see, on these extremes, nothing, just your normal order flow. But up here, look at this. On this red bar right off the high, what do you got? 5 lots, right? Traders aren't interested in buying this area up in here. The market sells off, sells off, sells off, sells off, from 72 down to 62, starts going sideways. Then you get down here, 4 lots, right? That, towards the right side here, you can see 4 lots trade on the bottom of this green bar, just going sideways, a little bit higher, a higher low. Another 4 lots. Market starts creeping back up. So prices are being rejected down here, down around the 62.5, 62, 61 and 3/4 area. Just as up here earlier, traders are now rejecting this 33.73 area. Call these small prints, right? Again, right off the high. You're making new high in each bar, 5-minute crude chart. Well, the next bar opens up, makes a run at that high, but just got no more steam left. Traders are exhausted from buying these highs, thinking we're going higher. Market sells off, gets down to the swing low, starts ticking up. Again, 9, right? It's a small print there. 1, it just goes sideways. Another 5-minute chart, right? Market is, in a range here, basically. Pops up a little bit, but traders aren't interested. 4 lots. What happens? Market closes down, then boom, falls over. So you get down here, you get down to this level around the 70 to 75 area, start rallying up. As you do, traders are rejecting these areas down here at around 75. Again, here's a chart. This is a 10-year chart. I mean, look at the volume that's going through on 10 years at a price level. 9,000 versus 12,000 at the same level. In the diagonal, you got like up here, you got 4,000 versus 5,000, 4,700 versus 5,700. But look at that. You got 3. You hit your high, start coming off, start to rally back up. You only got 3 lots transacted up here. On a market that trades how many thousands at a price level? Just as you have 4 over here, right before the market rallied up. Again, you got thousands being traded at a price level. 1, come on. Traders like to make things more complicated than not. Just look at the volume that's going through. If it's light, that's telling you traders aren't interested in those areas. Imagine what's going on. You hit your high, come off, start rallying, going back up towards your high, but you put in 3 contracts only? Fuck, man. This market's getting ready to sell off. Again, if it doesn't sell off, well, what's your risk? Your risk is, a couple ticks here. It's not like you're risking, the bank or anything like that. You got a very low risk trade. If you see this 3 lots going through and you don't realize that, that's important in the sense that, traders aren't interested in buying anymore, you're missing a great trading opportunity. It's a 5-minute Euro currency chart. I mean, look at this. You got your swing high here. You hit your low, rally up. You hit it. Bar closes. Next bar opens up. But only where's the follow through? Right? On minute-based charts, especially, you always want to be looking for follow through in the next bar. And you're not seeing it here. Right? You just see 3 contracts traded. You don't, previous bar trade 114 at that level. Next bar just 3 and immediately comes off. Right? And then sells off, making down new lows at the low of the day. What do you got? You got 1 contract traded at the low of the day before the market bounces back up from, the 35 area up to the 42 area. So hopefully by now you understand and see the importance of small prints. Now, I'm not advocating that you just automatically fade small prints whenever one appears, right? What I do is I look for areas where small prints and imbalances occur together, combined with a few other factors of order flow, but that's my starting point, small prints and imbalances. I'm not going to get into some of the other details, but I want you to grasp the importance of small prints and imbalances together, right? Because a footprint chart gives you the information, but you need to know what to look for and put it all together. So if you're looking at this chart, right, this is an E-mini 8 range chart, okay? E-mini 8 range chart trades thousands, anywhere between 5 to 15,000 lots in a bar. So, if you're sticking with, small print of, 5 or 10, yeah, you can. Honestly, I like to use a little higher threshold. I use 25 on very thick markets like E-minis. So where are you going to get, where's your trade? It's right here, this bar. If you're looking at, again, 8 range chart, where's the market exhaustion? Right, hopefully, you can start to see it over time, but it's right here. Here's your long, here's your short. Right, you've got, again, I told you I'm using threshold of 22, or sorry, 25. This is 22 here. This is 19. I've got multiple selling imbalances in this bar. I've got multiple buying imbalances in this bar. Where's the market exhaustion? I know some people are going to say, well, you got it right here, you got it here, but it actually occurs earlier. It occurs here. First time. Now, again, I told you there's other things that go into how I determine, but that's my starting point. Okay, so I've got my 25 threshold here. This is 16, falls within it. I got my multiple imbalances in here. I got a nice stacked imbalance actually. Again, if you're just using pure small print and multiple imbalances, you've got one here, you've got one here, you've got one here. Again, if you're using 2 imbalances, you've got another one here. So imagine that you're knowing you've got 1, 2, 3, 4 bars in a row, but you want to get in as early as possible. So for the untrained eye of the trader, it's going to be difficult to see. So how to make it easy? Well, I have a tool for that. It's called the Market Exhaustion tool for NinjaTrader. It runs on NinjaTrader 8. It's going to allow you to see areas where price is being rejected in real time by traders. Now, again, if you're looking at a normal footprint chart, where are you going to see it? You got to pick it up, and you got to know what you're looking for, right? You got to see, well, yeah, I've got my imbalances, I've got my small print, and like I said, there's a few other nuts and bolts that go into it. But if you're looking at it, sometimes you're looking at so much information on a chart that you just get overwhelmed, right? It's better just to have a tool that's going to highlight it to you, right? Like right here. Again, where is it here? Where would you want to be short from? Well, right here. This is your bar. Market starts selling off, circles back a little bit before it puts in that big move lower. Okay, 8 range chart, E-minis, where is it? It's right here. Crude oil 8-range chart. Where is it? It's right here. So, if you're interested in this indicator, it's just $350. And it comes with a 98-page user guide and settings, right? I could go over a lot of settings with you, which is important because, different markets, I think, have different settings. I also have an additional 1 hour and 36-minute training video. So if you're interested, go to marketexhaustion.com. Now, I've showed you how to spot market exhaustion on a volume footprint chart, especially using the market exhaustion tool from my website, Orderflows. But what if you don't use a volume footprint chart? What if you're just using a normal candlestick chart? Most people haven't made that transition to using order flow yet, in the sense of looking at a volume footprint chart. They're still using a normal bar chart, candlestick chart. If you're looking at this chart, you're just guessing, oh, there's market exhaustion here, or there, etc. Well, if you're using the tool, you can see there's market exhaustion here, this one failed, here's one here, here's one here, here's one little group here that failed. Then you got another market exhaustion here, market exhaustion here. Crude oil, 1-minute chart. That's what it looks like. In this chart, I've taken off these bars that go across, just so it's a little easier to see. And the beauty of it is, it plots it on there. So if you're using a tool like markers from the indicator store, you can hook it up, not hook it up, but you can set it up in there to, basically trade for you when you're not at your desk. It's crude 1-minute chart. Boom, 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 sell, sell, sell. Right? Here's the settings that I'm using. Sensitivity of 5. I got swing filter. I told you there's some other things that go into it, but here you can see the sensitivity is the small print, the imbalance triggers. I've got, whether it's looking, I'm going to take into some of the other bars, previous bars into account or not. You can turn it on, you can turn it off. Minimum volume required, whether you want delta confirmation, whether you want prominent point of control confirmation. Here's Euro currency, 1-minute chart. Again, previous chart was a crude oil 1-minute chart. This is a Euro currency 1-minute chart. Here's a sell, just sort of went down a little bit, went sideways, and then boom. You got the nice big sell here. You got a buy here, which just kind of went sideways. Unfortunately, it's not all going to be, the big massive move that you want. Sometimes you're going to get trades where, it starts out working, then it just goes sideways on you, right? That's what's called trade management. Again, settings are the same, right? The same settings, right? I'm using 5, 1, 5, check mark 1, 0, 402. Basic settings, same settings. Mini Dow, 1-minute chart. There's some buys, a sell. Bunch of buys, catching this entire move up here. This one, it's mini Dow. It's a lot thinner than crude oil and Euro currency. So I've adjusted sensitivity down a little bit to 2, and imbalances, I'm just looking for 1. Again, you could set these up to whatever you want to use. NASDAQ, 1-minute chart. Same thing, but buys in here. It's a buy right here, right around the cash open, which probably would stop you out. Then it starts coming back up, and it makes a move here from, 93, 92, 90 area. I'll hit to the 93.30s in here. Doesn't look like a big move, but it's NASDAQ, and trust me, that's a big move. It's because the way the market has been recently, you're getting big moves, right? So you want to catch those. And this one, it's interesting because, again, you can adjust the sensitivity. I got to set to 0, okay? Which basically, I'm just looking for multiple imbalances in a bar. 402. It's an E-mini 4-range chart. Okay. People say, well, you got this buy here that didn't work. Well, you got 1, 2, 3, 4 trades. 3 worked, 1 didn't. Okay, fine. Not all trades are going to be winners, but I want you to show that. I'm not going to just show you a bunch of charts where it's all picture perfect, right? There's going to be times where you get that because for whatever reason, right? After you get into a trade, market doesn't move just because you bought it. All the other traders also have to be going in the same direction. And with order flow, you understand what's happening in the market, what the other traders are doing, when they're being aggressive and whatnot. Settings still relatively the same. I'm using 3, swing period of 2, 402. Crude oil, 4-range chart. Sell, sell, buy, buy, sell, 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 sell. I don't even need to explain that. Again, sensitivity is 3, relatively the same on everything else. Again, I'm just showing you, this was earlier, this was the E-minis, right? Same settings on the 4-range E-mini chart that I'm using on the crude oil 4-range chart. So how else can you use this? Well, what about markets that move fast and have lots of volatility? And be honest, these markets nowadays have a lot of volatility and they move very fast. Well, why don't you just start by looking for bars with lots of imbalances, right? And how are you going to set it up? Sensitivity, you can make it a little bit higher. What about bars with 6 imbalances? Well, would you consider 6 imbalances a lot? Yes. And this is what it looks like. This is a NASDAQ 1-minute chart. Look at this. Sells, buys, sells. And again, again, not every trade is going to be a winner. This one is just purely looking for bars with 6 imbalances in them. And what was the other setting? Yeah. So you can see, do you think that's important? Do you think just imbalances by themselves are important? Well, yeah, they are. You can see here, obviously, bars with 6 balances is a lot. Okay, well, how about crude oil? 5 imbalances in the bar. Look at this. It's a 1-minute chart, right? Same settings, although this time I made the sensitivity a bit higher, 250, because obviously crude oil trades a lot more volume in a bar than NASDAQ. You can see imbalances 5. Look at that. And imagine if you're trading on a dome and you're alerted to this as soon as it happens, and if you're just a scalper, scalping, ticks here, ticks there, and you had a tool that's going to give you the immediate near-term direction of where the market is going, that can come in very handy, right? It's all nice, well and good to catch big moves. Right? We all like to catch that, but the reality is many traders sell themselves short. Right? They like to look at a dome because they think they're lowering their risk because they're not in a trade longer. Well, you need something to tell you what the market is doing in the next few ticks. And trust me, when you got multiple imbalances in a bar, usually, very highly often, the next bar continues that direction. Generally, it will continue that direction over the near term, but at least in the next bar or two, it continues it with a very high expectancy. So again, if you're interested in this indicator, it's $350. Go to marketexhaustion.com. It's not on my Orderflows site. I got a separate site for it, marketexhaustion.com. And again, it comes with additional training. It's got a 98-page user guide. I talk about a lot of the settings in there, and I show you in the user guide, different settings for different markets, and I explain them. Again, settings I use, it's not set in stone. That's what it has to be. You take those settings and you develop them into your own trading method, right? And you work it in there, right? Because again, not all markets are put in the same volume, right? Not, the volume that goes through on an E-mini chart is much different than the volume that goes through on a gold chart, right? The volume that goes through on a NASDAQ chart is much different than the volume that goes through on a 10-year chart. So, I think this tool helps a lot of people understand, when you have market exhaustion, when you have aggressive activity in the market, and, it's a great tool to add to your trading arsenal. So thanks for watching this presentation, and, happy trading. Enjoy.